right, today we're talking about stock transactions and the stockholders' equity section of the balance sheet. I thought that first I'd go over the stockholders' equity section of the balance sheet and get you a little familiar with the stock accounts before we looked at stock transactions. The stockholders' equity section of the balance sheet has two main sections. It has the paid-in capital section, which you'll notice up here at the top. I hope you've downloaded the handouts that go with this. You'll see a little colon after the paid-in capital section. And then it has a total down here for paid-in capital. So paid-in capital, what is that? It's everything that's been paid in by the stockholders when they purchased their stock. When the stock was originally issued, how much was it sold for? That money went into the paid-in capital section. In here we will see different classes of stock if the company has more than one class. But every corporation will have common stock. And you'll see that list up here first. Common stock is listed first in the paid-in capital section. Common stock is, they're the owners of the company. They have voting rights. They also have a right to receive dividends if they're paid. But if we go on down, you may see, not in this company, but some may have preferred shares. Preferred shares have preferential rights. And they have a dividend. When they're purchased, they're actually stated what the dividend will be. Now, a preferred stockholder only gets that dividend if dividends are declared by the board of directors. So there's no guarantee they will get that. However, they get first. They get their dividend first, and they get that set amount. Whereas the common stockholders would get paid second. Preferred stockholders do not have voting rights, so they have some things in common with bondholders or creditors, but they are considered owners. After you see the word common stock, you see this word $80 par. So the par value will be stated. What is the par value of the stock? What does that mean? A par value is actually set for stock when the corporation initially applies for its charter with the state that it's incorporated in. They specify how many shares that they are planning to issue and what the par value will be. And when it's approved, the par value stays the same, and the number of shares are going to be the ones that are authorized by the state. So the company can't just decide to go out and print up more shares of stock if they have not been authorized by the state. But by including this information in the stockholders' equity section, it's available for the business stakeholders, the investors, anybody that would want to know this information. All right, what par value is actually legal capital. And so when the company pays dividends, they're paid out of retained earnings, but they should never be paid out of the par value of the stock. Stock is sold, of course, on the open market for the market value. Market value is generally much higher than par value, and market value can change even throughout the day. If you watch the stock market, it can go up and down. Any amount that is the par sells for over the par value goes into an account called excess of issue price over par. It's also called, I've seen it called paid-in capital in excess of par. So these two types of accounts are used interchangeably. It says here there's 60,000 shares authorized and 40,000 shares issued. What's the difference between authorized and issued? We talked about authorized being those that are established that can be issued to the stockholders, but sometimes they're not all issued. So in this case, this company has 60,000 shares they're authorized to issue, but they've only issued they've only sold 40,000, they've only sold 40,000. The dollar value that you'll find in that common stock account will be the par value times the number of shared issues. So that's where that number comes from. Anything that the stock is sold for over par value, as I mentioned earlier, will go into this next account, excess of issue price over par. Okay, if we had preferred stock, it would be listed next. If we don't, then there's no preferred stock in this business. The next line is paid-in capital from sale of treasury stock. Let's talk a little bit about what treasury stock is. Treasury stock is stock that the company has issued first to the shareholders, but it's bought the stock back and put it in the treasury. But the way this says from sale of treasury stock, so if the company had stock they had bought back, it was in their treasury, and they sold it again, now it needs to come up in the paid-in capital section. So that's from selling treasury stock. These three numbers together are what this particular company has as far as total paid-in capital. Going on down, retained earnings, we mentioned, was all the earnings that have been retained in the business, not paid out in dividends. If the company had a net loss, which is not all that uncommon these days, it would be subtracted from retained earnings, and it would reduce retained earnings the same way that dividends do. When we add those two together, those two numbers, the total paid-in capital plus retained earnings, again, these are the two main sections of the stockholders' equity section of the balance sheet. We get the total stockholders' equity. From that, if we purchased any treasury stock back, meaning we bought it on the open market from our stockholders, it goes into an account called treasury stock, and it must be subtracted from the total stockholders' equity. Why is that? We subtract treasury stock because when we buy it back, we're paying cash for it, so we're reducing cash. But we're also shrinking the stockholders' equity in the business. It's the opposite of issuing stock. When we issue stock, we bring cash in, and the money in our stockholder accounts are increasing. When we buy it back, they're decreasing, and the way we decrease it is by deducting treasury stock here at the very bottom. An interesting thing about treasury stock is if the company holds on to it and they sell it later, there's no gain. They don't have to show that as a gain from selling treasury stock. If they lose money, they don't show it as a loss either. It's all handled. It just switches from deducting treasury stock back to from sale of treasury stock. So it switches between those accounts, and we bring it back up here.